Hello everyone, welcome back to my online classes, and in today's video I'll show you how to pass journal entries. Let's begin. Basic definition of journal, the introduction to it. A journal is a daily record of business. It is also called a day book and is used for recording all day-to-day transactions in the order in which they occur. So as they happen, it is being recorded. This is what is called journal. It is a book of prime entry or regional entry, as all the transactions are recorded first in this book. So this is the point of start for accounting. The accounting begins with journal entry. After journal entry, only other things happen. The process of recording is called journalizing, and the entry in this book is called a journal entry. Format is like this. It has 5 columns, starting with date. Whatever date it happened, we have to write one by one any number of entries. And in the particulars, there will always be at least 2 lines. First line will be for the account name which is being debited, and the second line will be starting with TO, letter 2, and then the name of the account which is being credited. Then we have LF, that is called ledger folio. It simply tells the ledger folio in which this particular journal entry will go. Then we have debit and credit amount column. Here we'll write the amount by which particular account is debited or credited. Suppose the first line, I said the name of the account which is debited, I'll write in the first line. So whatever name of the account I'll write there, against that I'll write in the debit column the amount. Suppose 10,000, I'll write 10,000 there. In the credit column, I'll leave it empty. Then in the second line, as I said, this will be the name of the account which is being credited. So we will write the amount in the credit amount column and leave the debit amount column empty. After that, we'll simply write a narration. Narration is nothing but just an explanation of what is happening in the particular journal entry. So let's begin with few examples. How to pass journal entries? Let us take a common example, and which is the best is Raju started business with cash rupees 10,000. What is happening here is an owner is starting a business. Now I'm giving the name of the owner as Raju. Now here you have to worry about the business entity concept, which says owner and business are separate legal entities. Okay, so here when we are passing journal entries, we have to assume that we are passing entry for the business, not for owner. Okay, so business and owner can enter into some contract. So here what is happening, Raju is giving money to the business, and business, what is happening, business is receiving the entry. So you can see there are 2 people here. Okay, so in this transaction there are 2 accounts that are being affected. You have to analyze it like this. What is happening in this transaction? First is cash is received by the business. So cash is received by the business. What is cash? It's an asset for the business. Is it something going out? No, business is not giving anything. But since Raju is introducing capital, we call it a liability for the business. So 2 accounts that are being affected here is cash, one is asset, the other is a liability account. Here this liability, since it belongs to the owner, we call it capital account. Every time owner introduces something or reintroduce something, additional capital he brings in, some furniture he brings in, some stock he brings in, everything will be put under one name account called capital account. So if we use the rule of debit and credit, cash is a real account. So the rule says debit what comes in and credit what goes out. So since cash is coming in, so we will debit the cash account in the journal entry. Then capital account is a personal account. It belongs to a person. Debit the receiver, credit the giver. So since Raju is the giver, so we will credit the capital account. Raju is the giver of the cash. So Raju's name, we are instead of Raju's name, we are writing capital account. So if we write this transaction in the journal entry, it will look like this. See, first column date, you can write whatever date is happening. Now you can see in the particular column there are 2 lines. There, of course, there are 3, but third one is under the bracket, so I'll not worry about that. First line is cash account debit. Why I'm debiting cash account? Because cash is coming inside the business. The rule says debit what comes in. Cash is coming in. It's an asset coming in. So I'm writing the cash account debit. Now I'll straight away go to debit amount column and write the amount which is 10,000 rupees and write nothing in the credit column in the first line. Now in the second line it says 2. Whenever we write 2 in the journal entry, it suggests that the following account name is being credited. So we are writing to capital account. Capital account is being credited. Capital account being Raju being the giver of the cash. So capital account is credited. And you can see we are not writing anything in the debit column for the second line. We are writing in the credit column 10,000 rupees. So now our debit and credit are both equal. Okay. So now the third line, that is, have we started with being, it is nothing but narration. Narration simply means whatever is happening in the above entry, you write there. So here, as per my understanding, capital is introduced by Raju. So I'm writing being capital introduced by Raju. I can also write being cash paid into the business, or being Raju brought capital in the business. I can write anything I like, whatever I understand by the above transaction. That is not important. What is important is the first two lines. Which account is being debited, which account is being credited. Cash account is debited because cash is coming in, and capital account is being credited because capital is a personal account. So credit the giver. Who is the giver? Capital. Capital means owner. Owner is who? Raju. So this is a very basic transaction. Let's try some more transaction. Another very peculiar and simple, very common transaction that you'll see in business is purchase of goods. Now, what are goods? Goods are nothing but tradable items, items that you buy to sell it. These are, items that you are doing business on. Suppose for a chicken seller, chicken is a item. For a bookseller, book is an item. Goods, because they are buying books from somewhere and they are selling to someone. For maybe for a mobile phone shop, mobile phone is a good. Okay, so in this transaction, let us analyze it. We are purchasing goods. Business is purchasing goods, not the owner. Okay, of course owner is involved, but for the accounting purpose we'll assume business is the one who is purchasing it. So purchase goods for cash rupees 2,000. What is happening? Goods are coming in and cash is going out. Cash is going out, it is for sure. Let's see. In this transaction, there are two accounts that are being affected. Cash is paid by business, an asset for the business, and goods are received. Here, you may say goods is an asset. Yes, of course, stock item that we are buying, it is kind of asset. But since we purchase very often and we do not, we do not intend to keep this good in the business forever or for a long period of time, we do not consider it as an asset. Rather, we consider it as an expense. We may purchase every day. We may purchase 10 times in a day. We may purchase different items. Okay, and we may sell it also in the same day, or maybe after 2 days, or after 2 months, or maybe a year. Doesn't matter. But whenever we are purchasing goods, the tradable items, we are not intending to keep it in the business. So we will put all these items that we are purchasing for selling under one account called purchase, and purchase is treated in accounting as expense for the business, not a real account, not a cash or building kind of account. So cash is a real account, debit what comes in, we are purchasing, so we are paying the cash, so cash will be credited in this transaction. And goods purchase is a nominal account, so nominal account rule says debit all expenses and losses and credit all incomes and gains. So purchase is an expense, so it will be debited. So it will be seen, it will look like this in the journal entry. We'll make one more column row in the journal entry, write the date, and we'll write purchase account debit to cash. Purchase account is a nominal account. Debit all expenses and losses. Purchase is an expense, so we are putting purchase in the debit column, and in the debit amount column 2,000 rupees. And since we are purchasing, we are paying the cash out, so cash is in the credit column to cash account. Cash is going out. Credit what goes out. Cash is a real account, it is going out. So in the credit column we are writing 2,000 rupees, and in the narration we are writing being goods purchased for cash. That's it. Let's go to the next transaction. Another very peculiar thing that will happen in a business is purchase of assets, fixed assets. Just now we purchased goods and we consider it as an expense, but this time we are buying another thing which is also an asset, but this time we are purchasing again. But this one is not intended to be sold. Okay, we are not buying this building to sell it again, so we will not put this building under purchase account, but we will create a separate account for it, which at the name of this particular asset only. This is building. Suppose we buy plant and machinery, we'll write plant and machinery a separate account. We buy furniture, we make it furniture. Motor vehicle, buses, trucks, whatsoever, we will create a separate account for it. So here in this transaction, what is happening? Cash is paid since we are buying building. Cash is an asset, and building is received, an asset for business. So both are real account. Cash is real account, debit what comes in, credit what goes out. Building is also a real account, debit what comes in, credit what goes out. So both of them are real accounts. So debit what comes in, credit what goes out. That rule you have to use here. Entry will look like this. Please look at the third row. Debit what comes in. We are buying building, so building is coming in. So we will write building account debit 2500 in the debit column. Credit what goes out. Cash is going out, so we will write 2500 in the credit column, and we'll write 2 cash here in the narration, being building purchased. See, both are real account. Okay, now in the second entry you see purchase stock. It was also something like a asset, but since we buy it to sell it, so we write in the purchase. But building, we don't buy it to sell it, we buy it to keep it, so that our business will grow. It will have more assets, more space to produce, more space for office and all. Okay, let's try another example. Sold goods for cash rupees 1250. Now if you have understood the second entry, that is purchase goods, we are buying tradable items to sell it, and we put all these items under one account called purchase. So here those items that we have purchased, now we are selling it. So if you have understood second one, it will not be troublesome for you here. In this transaction, 2 accounts are being affected. Number 1, cash is received by business because we are selling. It's an asset, so real account again. And goods are sold or going out. Okay, this going out you can omit. Just like purchase was an income for the business, purchase was an expense for business, goods are sold is an income for business. Please, my apologies for this expense I have written here. It's not an expense for business, it is income for business. My apologies. So when we are selling, we receive money, and since we are selling goods, we assume that it's an income for the business, and we sell multiple times in a day, sometime maybe 10, 20, 30 times. For big companies like Amazon, Flipkart, in a day maybe they are selling maybe 1000 time, maybe 1000, more than 1000 people also they are selling, who knows. But for a small shopkeeper, maybe he's selling 10, 20, 30 customers only. So it is a regular event that happens every day. So we, whatever items that we sell, whatever item that we have, tradable item that we have bought and now we are selling it, we'll put all of them under sales account only. So, and we'll call it as an income. Cash is a real account, you understand that, and goods is a nominal account. Debit all expense losses, credit all incomes and gains. So we are selling goods, so it becomes nominal, but this time it is income, and we'll club them all under sales, not goods. The entry will look like this. Since we are selling, cash is coming in, so you understand by now. Here you can see the first entry, cash is debited, cash got received as a capital, and this fourth entry again, cash is received as we are selling goods 1250. To sales account, sales is an income for us, so the nominal account rule says debit all expenses losses, credit all income and gain. Sales is an income for the business, so we are crediting it. And in the narration we are writing being goods sold. Let's check out another transaction, very common one. This time we are talking about expenses again. What is this transaction? It says paid salary. My mistake here again. This is the fifth entry. This is not entry number 4, it is number 5. So paid salary, what is happening? Again, salary is being paid, that means cash is going out. In this transaction there are 2 accounts that are being affected. Cash is paid by business, an asset for business, and salary is paid, an expense for the business. Salary is an expense for the business. Please do not say that salary is being paid to people, so it is personal account. No, it is not. Okay. Cash is a real account, salary is a nominal account. So since salary is an expense, so debit all expense losses will apply here. The entry will look like this: salary account debit, salaries and expense. So it says debit all expenses and losses. The nominal account rule 1000, and to cash is going out. Very simple. It will be credited. In the narration we will write being salaries paid. So guys, this salaries and expense. Similarly, there are other expenses also like wages, maybe directors fees, audit fees, stationery, advertisement expenses. So many expenses that are of recurring nature that are paid by a business. Electricity bill, even telephone bill, internet bill. All these things are paid. So for all these expenses which are recurring in nature, the transaction will look like this: salary account debit to cash, or wages account debit to cash, or internet bill account debit to cash, or this fees account debit to cash, whatever. So salary entry will look like this if it is paid in cash. So that's it for today's video, and the transaction that we have covered in this video is capital introduced, purchased goods, purchased building, sold goods, and salary paid. 5 types of basic transactions we have covered in this video. I hope you have understood it. For again, I'm telling you, for understanding this transaction journal entry, you must be well versed in the rule of debit and credit, the golden rule of debit and credit. If you understand that, then this video will be beneficial to you. If you understood everything, give it a thumbs up. If you have some doubts, kindly comment, and I will definitely reply to it. Thank you so much for watching. Have a nice day, evening, morning, whatever your watching time is. Thank you.